Let's get more on the potential market implications from Marko Kolanovic, the Chief Global Market Strategist at JP Morgan. Marko, great to have you with us tonight. We certainly saw the markets react to this. For New York City, for the top earners in New York City, and I know that's a very maybe parochial way of looking at it, but just to give you an example of how hard this could hit, the combined marginal tax rate on capital gains could total 58.2% in New York City for the top earners. Do you think this could have an impact on the markets?
So it could have an impact, but I think it's a bit too early to say. First we need to see what is the proposal. Then there are also details. What is the level? When is it applied? Is it this year? Is it next year? It has some implications on the flow. And then finally we need to see whether it passes. So I think it's a little bit too early to conclude. But clearly, market today had a negative reaction.
Yeah, anything past this? Let's just play this game with me, Marko. Humor me for 2 minutes. But let's say something is passed this year, and they say it's going to be effective, the day it 2 months after it passes. In terms of impacting the flow, you expect selling in advance of the passage of the cap gains tax raise.
So if it's applied for the next year, and investors can take advantage, then it would imply probably selling of winners. So there will be probably some rotation out of momentum, and perhaps some of the sectors like growth and momentum market segments. So anything that went up a lot over the last few years. But that's purely hypothetical, right?
Sure.
Again, we really don't know any of these details now.
Yeah. Okay. Let's put that aside from now, Marko, and get your view on the markets, because you actually think that earnings season is going to prove and give the fuel for another leg higher, particularly in the value and the cyclical names. And I know that you're not a specific stock picker, but, I looked at Whirlpool's earnings yesterday, and they were very good. The outlook was very good. It was a company that, even though it's facing pricing pressures, it has power to pass these increases along to consumers. Everything was great. Today, it's traded sort of on the back of that. So why do you think earnings season is going to give the markets fuel for another leg higher?
So it's actually less really of an earnings season. I think it's going to coincide with the earnings season, but our thesis is really that the COVID in the U.S. is going to start declining very soon. For two reasons. We have already some natural immunity, and immunization is going pretty well. So we think it's not yet reflected in the numbers, and we think that's going to happen very soon, sort of in the next maybe 1 or 2 weeks. So it's going to coincide with the earnings, but earnings are also going to be decent. So we think that basically both positive earnings as well as improvement in COVID situation in the U.S., which we expect them to see later on in Europe as well, will basically drive some rotation from sort of defensives into cyclicals, from growth into value. And we also think that's going to coincide with the bond yields taking higher and sort of driving also that rotation. So decent earnings, improvement of COVID situation in the U.S., bond yields resuming sort of move higher. We think it's going to be positive overall for the risk, and especially for the rotation, sort of from growth into value, from defensives into cyclicals.
Hey, Marko, thanks for joining us. Bonawyn here. So reading through your notes, like you've mentioned some of the areas that you foresee rotation into. Would you mind shedding a little light into some of the choppiness that we've seen in the financial and small caps in the last, 3 weeks or a month?
Absolutely. So, you noticed that very well, actually. Last sort of 3 or 4 weeks, the market actually moved the opposite way. You had a rotation away from cyclicals, away from small caps, into more sort of mega caps, higher quality names and growth names. So that was sort of last 3-4 weeks. What was driving that? Few different reasons. One, we did have some negative news globally on coronavirus, especially around India, Brazil, Turkey. We also had some uncertainty around Johnson & Johnson vaccine. So that was the one driver. The other driver was bond yields sort of stabilized and actually ticked a bit lower. And equity investors saw the bond yields going lower, and then they basically rotated back, sort of from reopening trade from cyclicals into the quality, into the large cap names, and more into the growth. So we think sort of that reversion now is over, and we think we will resume sort of back into sort of reopening trade, reflation trade, and we think that yields will continue on their paths higher.
Hey, Marko, it's Tim. Right. So I like the energy trade. I like the reflation trade. Help me understand the context for where yields can go. And also, tell me where the dollar is going to be by the third quarter. And I think I can tell you somewhat how those trades are going to do. So your call on that, please.
Sure. So look, it's very hard to say where exactly dollar is going to go, where it's going to be. But we think sort of both yields go higher and dollar on the margin goes lower. So where can yields go? We think sort of by the end of the year closer to 200, 195, 200. That's a base case. Obviously that can go either way. If we do have a sort of stronger reopening and stronger inflation, probably can overshoot a little bit. If the sort of growth a little bit disappoints, can be lower. But we think higher from here. So sort of if we are now at 155 or so, we think they're going to start actually marching higher. And we still think that's going to be good for equities broadly. It's going to be, and especially good for value and cyclicals. So we also don't expect that path to go. The yields to go too fast, like we saw basically in January or February. The reason for that is, as I mentioned, a little bit of this reopening. Reopening starts in the U.S., and then with some delay, call it 2 months, happens in Europe. So if it was basically reopening everywhere at the same time, maybe these yields will overshoot. Now, because we expect a bit this recovery to be staggered, starting in U.S., then Europe, and then emerging market, I think that's going to allow yields to actually move at some slower pace, which is not going to sort of spook the equity market. So that's sort of on the yields. On the dollar, I don't have a very strong conviction. I do generally think with basically more of a pro-risk reflation, inflation type trends, the dollar will go lower from here. How much, I really don't have a very strong view right now.
Shepard Smith here. Thanks for watching CNBC on YouTube.